Hi there, my name is Tyler Haw. Let's talk about tax loss harvesting. Not every trade you make will be a winner, but all losses are lessons. And if you use them right, there's also a way to lower your taxes. It's called tax loss harvesting, and today we'll break it down and show you how to make it work for you. This strategy could help traders of all experience levels to optimize their investments and save on taxes. But as we start this run through, it's important to mention the information in this video is for educational purposes only and does not constitute financial or tax advice in any way. Always consult a professional tax expert for your unique situation. So, what is tax loss harvesting? Let's quickly run through the basics of how it works, who can do it, whether it's right for you, and a couple of things you should know if you're considering this strategy. Firstly, there are 3 scenarios in which you might want to consider tax loss selling. Number 1, you have a taxable capital gain in this tax year that you want to offset by triggering a capital loss. Number 2, you have a taxable gain in any of the previous 3 tax years, and you want to trigger a capital loss in order to carry it back and reduce your historical gains. And number 3, if you hold a position that's at a loss and you're not confident in its outlook, consider selling it to limit your downside risk. If you don't have capital gains this year or in previous years to offset, that's okay. You can carry this loss forward to future tax years, allowing it to reduce taxable gains down the line. In each scenario, you're choosing to use capital losses to balance out capital gains and reduce the amount of taxes owing. So, in this video, we'll mainly speak to the first example, but tax loss harvesting can work differently for every trader. It's important to know, tax loss harvesting can only be done in taxable, non-registered investment accounts like a Questrade cash or margin account. That means you're not able to use this strategy in tax-free accounts like a TFSA, RSP, FHSA, or RESP, since capital gains are not taxable in those accounts. But if you haven't opened a taxable non-registered account yet, you can get started using the link below. When you incur a capital gain in a taxable account, a portion of those gains is included in your taxable income. What that also means is that losses in taxable accounts can offset or reduce those taxable gains. Think of it like a scale. Your capital losses balance out your capital gains, reducing any taxes you may owe. You're then free to reinvest the cash elsewhere. Just be mindful of the superficial loss rule, which we'll cover a little later on. Now, in order to use your losses to offset your gains, you have to make sure your trades are fully settled before the end of the year, which means you need to know about the T+1 settlement. In trading, T refers to the date when you actually make the trade. T for trade. However, the trade isn't completely settled until the next trading day, hence the +1. This is important if you're trying to meet year-end tax deadlines. So make sure to get your taxable trades in by Monday, December 30th. If you can practice tax loss harvesting in your account, it's important to remember the superficial loss rules. Generally, this means you can't sell a security to harvest a tax loss and then immediately buy it back. You need to wait at least 30 days. Also, keep in mind that the superficial loss rules applies to all accounts. You can't get around it by selling in one account and buying in another. Make sure you're okay with not holding that security for at least a month to comply with this rule. This also applies to affiliated persons like your spouse or a corporation controlled by either you or your spouse. When you're considering where to reinvest the cash from tax loss harvesting a position, it's important to make sure you don't buy back a security that could be considered an identical property. For example, buying the same index ETF just from a different issuer would be considered a superficial loss since the 2 ETFs track the same underlying index. If you're ever unsure if an investment counts under the superficial loss rule, contact a tax advisor and they'll be able to help you out. Let's take a look at tax loss harvesting in action. Let's say you bought $10,000 worth of shares and sold them for $20,000, giving you a gain of $10,000. Half of all the capital gains you make in a personal account are taxable. This is known as the inclusion rate. If you have capital gains above $250,000, however, the inclusion rate is higher at 2/3, but let's keep things simple for our example here. So in this case, it adds $5,000 to your taxable income. Now, let's say you also had different shares that decreased in value, bought for $12,000, sold for $5,000. That's a loss of $7,000, and while this is never nice to see, it can still help reduce your taxable gains. So let's quickly knock that loss off your gains and recalculate your taxable capital gain. As you can see, this reduces your original gain and your taxable income drops from $5,000 to $1,500. Depending on your individual circumstances, tax loss harvesting can potentially eliminate your tax liabilities from capital gains. If you have $10,000 gain and a $10,000 loss that you can apply to it, well, they cancel each other out. Another important thing to remember is that you're responsible for tracking your cost basis, or the average price you paid, starting from when you first acquired your shares. For a full explanation on how this works, search for our article called Average Price and Adjusted Cost Base on our Learning Center. What I want to emphasize here is if you transferred shares into Questrade, you may need to check with your original financial institution for the purchase price. Now, if you have any of your old statements, we can help adjust the average price for you so it displays more accurately across all Questrade platforms. You'll notice this change when you look at the positions information of your self-directed accounts. So let's recap. Here are some key things to remember. Number one, remember that tax loss harvesting can help reduce your taxable income, but only in non-registered accounts. Number two, be mindful of the superficial loss rules and don't rebuy the same security or one that can be counted as identical for at least 30 days. Number three, consider reinvesting the cash from tax loss harvesting into similar or new market segments. And finally, make sure you time your trades correctly and account for settlement with year-end deadlines. If you want to make the most of your investments and reduce your tax burden, consider consulting a tax advisor to see how tax loss harvesting can work for you. Don't have a taxable account yet? Click on the link below to get started. Thanks for watching.